Hi everyone. I wanted to talk to you about exchange traded funds tonight. Consider this a public service announcement from Bag of Dawn at stockmarketcaddy.com. But let me point out to everybody, I'm just a guy that trades his own money for a living. I am not a broker, I am not a broker, I'm not a financial advisor. And I just want to pass on a little information with regard or concerns, a caution regarding exchange traded funds. You're looking at the SPY, IWM, the Diamonds, and the QQQs. These ETFs have been around for some 25, if not 30 years, many of which are what they call cap-weighted. These ETFs, XLV, Healthcare, XLP, Staples, XLE, Energy, Utilities, Biotech, Consumer Discretionary, the Financials, GDX, Transports, Regional Banks, Retailers, Semiconductors, Industrials, Technology, and the Builders. These, for the most part, have only been around since about 2004, 2005. They have, for all intents and purposes, replaced in large part what many of us used to invest in back during the 80s and 90s, mutual funds. Mutual funds were also a basket of stocks representing various aspects of the market, and there were as many mutual funds, if not more, than the individual stocks. These exchange-traded funds are fairly limited. There's about 10 to 12 that represent the entire sector. The appeal to the public on these exchange-traded funds is the fact that you're able to enter orders and ostensibly exit orders during the course of the day. Also, they do not carry the fees associated frequently with many mutual funds. It is our view, though, that these exchange-traded funds were created, particularly these sector funds, just a year or two before the crash in 2008, for the reason being that the powers to be, the banksters, the Federal Reserve, that it would be much easier for them to pour money into these exchange-traded funds at the depth of the crash to give the appearances that there was a floor in the market, or that there was a market when there really wasn't. Now the public has grasped onto these exchange-traded funds in a large way and are pouring money into the exchange-traded fund like no tomorrow. Now there are some concerns that you need to have. First, in a cap-weighted index, the larger the company, the larger the market capitalization, the more weighting that stock gets in the index, which presents almost a money chase if you think about it. Goldman Sachs, part of the Dow, has moved almost 100 points in 30 days. That one stock has moved the Diamonds almost 4 points, or the Dow index almost 400 points alone. So it can create a money chase, which is great, of course, if you're a banker. That's what they want. The other concern that you should have is the idea that these are liquid. You will hear frequently the folks on the Contrarian News Bubble channel, CNBC, talking about the markets melting up, climbing a wall of worry. On the way up, there generally isn't much concern for liquidity. And that, by the way, generally, markets melt up. We've had a tremendous move in just the last 30, 40 days. In the euphoric stage, markets move up quite fast. But when the tide turns, and whatever reason, when that tide turns, there could very well be a concern, and I would have that concern for the liquidity, for the ability to be able to sell this to some other sucker. Let me explain. Let's say today you push your button on E-Trade with your IRA account and bought a mere 1,000 shares, and at Schwab, those 1,000 shares of the SPYs, they are such nice guys, they'll let you buy them for free. They'll even let you sell them for free. Imagine that. You could buy $226,000 worth of the SPYs and they won't charge you a commission. Of course, what they don't tell you is they sell your order. They sell your order to a high-frequency trader, and he steps in between you and the marketplace. And what he will do is probably charge, maybe 25, 30, 40 cents a share. So although you paid no commission, the share price, you will actually pay an extra 20-30 cents. You'll pay $300-400 at least to get into the position. That's one concern that you need to be aware of. The other concern is if you put in what they call a stop loss. Let's say you're concerned should the market crash for any reason, and you tell your broker, I want to put in a stop loss 5% below where I entered. Now, God forbid, but let's say tomorrow a rumor floats around. You've already put the order in today. A rumor floats out there that a plane is flown into the White House. God forbid. The market begins to crash and falls almost 50%. You are not guaranteed to get out at the 5% level, because at that 5% level, your stop loss turns into a stop market order. You conceivably could lose half of your value if that's where the first buyer was, and you'd be stopped out at a 50% loss, not a 5% loss. The other, if you find out at the end of the day that it was just a rumor, entirely possible that the market comes all the way back, but you would have lost half your amount. So then your broker says, well, I'll tell you what we'll do. We'll put in a stop limit of 5%, 5 to 7, so that if the rumor hits, you get out at 5% or at a maximum 7% loss. If it goes beyond that, you don't get out. Your order does not get into a market. So at the middle of the day, the market's lost half of its value, and you've lost half of your value. Unfortunately, this time, at the end of the day, you find out that the event was actual, and it doesn't bounce back. You still hold the shares. And on top of that, if you decide not to use a stop out, a stop loss, decide not to use a stop limit, and overnight an event happens, like 9/11, the market could be closed on you for 1 day, 2 days, 3 days, 4 days. 9/11, it was closed for 5 days. They will open the market where they believe there are buyers. They could open the market down 10%. If there are no buyers, it would close within minutes. You'd be down 10%. They could open the market the next day, limit down 10%. If there are no buyers, it could close. The market will ultimately transact where there are buyers. It could be 30, 40, 50% down. So you are not guaranteed by any means liquidity in any of these exchange traded funds. Now, there are steps you can take to try to protect yourself from that kind of event. You're not going to hear about those steps on the Contrarian News Bubble channel. You're probably not going to hear about it from your broker. You're probably not going to hear about it from your financial planner. You know, I asked about it in the 1999s, in 2000. And my Merrill Lynch broker at the time said, Don, you got to be kidding. You know, if your investment in Merrill Lynch goes bad, you know, we got a whole lot of things. If Merrill Lynch goes out of business, the whole world's coming to an end. Well, folks, Merrill Lynch, for all intents and purposes, went out of business. It's that black swan. So, word to the wise, be careful. If you're pushing buttons with your IRA accounts and buying thousands of these ETFs in any of these sectors, you're not alone. Many, many people are playing that game. If the tide turns for any reason, you need to understand that you will get out at the price in which it is bid. The bank is not going to take the hit for you. Be careful. And if you find this helpful, please forward it on to your friends and family. Mark it with a thumbs up. Feel free to check out our little site. I'm Bagadon at stockmarketcaddy.com. I wish everyone the best.